Good morning and good afternoon to our UK colleagues. We are super excited to share with you today some US tax considerations for UK entrepreneurs who are moving to the US. This is a very common practice and something that we deal with on a regular basis. And so I will start with just introducing our presenters. First off, we have Jared Johnson. Jared is a principal with our international tax practice here at Eide Bailey. He also leads the global mobility practice. So, and all things individual, cross-border, Jared is your person. I'm Shannon Smith. I am partner in charge of the international tax team at Eide Bailey. Been with the firm for 10 years, and I'm based in Colorado. I forgot to mention Jared is based in Utah. And we, of course, have Caroline Monk. And Caroline, I'll just let you say a few words about yourself.
Thank you, Shannon, and thank you. It's lovely to be with you all again, even in this virtual environment. So I'm Caroline Monk. I'm one of the executive partners at Beaver and Struthers. We are an HLB member firm in the UK. And I'm very excited to listen to Shannon and Jared talking today, talking about what UK people need to consider moving to the US. This is part of a series of webinars we've been hosting with Eide Bailey, looking at what we need to consider if we're moving to the US and vice versa, people coming into the UK. And I think it just really reflects the best of HLB, where we're all working together as firms to help our clients and our relationships achieve their best results wherever in the world they want to be. So with no further ado, I'll pass you back to the experts in the US world. Thank you.
Thank you. So today's agenda, first we'll cover the income tax considerations and move right into transfer tax considerations for UK persons coming to the US. And then of course, we have lots of trust in our world in the cross-border context. These add a number of complexities, so we'll cover that as well. And with that, I will turn it over to Jared to walk us through those individual income tax considerations.
Thank you, Shannon, and welcome, Carolyn, all the way from the UK. So happy to have you join us today. And so this is a really exciting topic for me. This is my passion, and helping individuals, especially inbound individuals coming into the US. And I like to think, US taxes are very complicated, and they're even more complicated for someone outside the US coming in that's been completely foreign to US tax reporting. And so I find it very rewarding when I have the opportunity to teach and help someone that's coming in, and help them understand about US taxation and how we can help them plan and strategize. There's a lot to consider, and we have a lot of material to go through today. Hopefully we can make it through all of it. And Shannon already went over the 3 objectives that we're going to try to accomplish and go through today. So with that, we will move on to our first slide. And we're going to talk a little bit about the basics of US tax compliance. So again, just a reminder, as Shannon hit on this earlier, this webinar is mainly focusing on UK entrepreneurs moving into the US. So unlike the UK's tax filing season is an April 5th to April 4th tax year. The US is a calendar year. So there's already a big issue right there, just reporting tax year's fiscal year versus calendar year. The US has an April 15th filing deadline with an opportunity to extend that, just the filing of the return, not the payment of tax return, of tax liability, but they have the opportunity to file an extension to extend the return out to October 15th. One of the first things I always, people will talk about when they move to the US, right? Or they've already moved, I'm talking to them. One of the first questions always comes up is, what is your immigration status? And believe it or not, even in today's day and age, some people will come to the US without thinking through the process. Well, I better get, if I'm going to work in the US, do I have a work visa? Am I working illegally in the US or am I not? And so these are all things that need to be considered. Like that's a very important step. If you're going to come to the US and you're planning on working, make sure you work with an immigration attorney to make sure you're being coming in on the proper work visa. There are types of visas, believe it or not, that affect your tax filings in the US than residency. They probably aren't the type of visas that UK entrepreneurs would have coming into the US, but sometimes I've seen it where they come in, the ones that that affect your filing status in your and your residence are generally your student visas or your trainee visas. And I've seen it where I've had entrepreneurs come in on a training visa and then want to stay here and then transfer it to an e-visa or something out like that. And so there's implications there. And so you need to be aware of that, and you need to talk not only to an immigration attorney, but a tax person to help you understand what those implications are. The other thing that really comes up on those first conversations is, do you have a social security number? And if you don't, are you eligible for one? If you're coming in on a work visa, you are eligible for a social security number. And if you're not eligible for an ITIN, I get a lot of questions about, can I just get an ITIN? You have to have a tax purpose to have an ITIN. You can't have an ITIN if you're eligible for a social security number. So for those of you that may not be aware, an ITIN is an individual tax identification number designated by the IRS, the Internal Revenue Service. It is not a number that is issued by the Social Security Administration. That's the Social Security number. And the Social Security number trumps the ITIN. So if you're eligible for a Social Security number, you need to go get one before you start working, preferably, and get all that taken care of. If you need an ITIN, we can definitely help you with that. Or if a family member needs an ITIN. ITINs are generally applied for with the filing of a tax return. It generally can't be applied for before the filing of a return. And sometimes there's, if it's a non-resident alien that has a U.S. property that's generating income, that would be a time when somebody would want to apply for an ITIN. They're not working in the U.S. They have a U.S. filing obligation, or if they have U.S. assets have withholding, there's other rules around that. So a conversation for another day.
Yeah, I will just mention one very common exception to that rule of getting the ITIN with the filing of a tax return. And this may apply to UK entrepreneurs that invest in a US partnership. And in that case, you are eligible to get an ITIN so that when the tax withholding happens throughout the year, that can be allocated directly to your tax ID number. So that's something that can be done in advance, but one of the rare exceptions.
Yeah, thank you, Shannon, for bringing that up. That is really important to do that before. So when you begin investing, and preferably not after payments are starting to make. So when you begin that investment, that's the time to reach out and get some guidance, U.S. tax guidance. So, all right, next slide. What are the common U.S. taxes is another question I get from a lot of people. And we're going to focus on federal income tax. So federal, I mean taxes that are paid to the Internal Revenue Service or the U.S. Department of Treasury, the federal government. These are all taxes that are kind of handled through the filing of a tax return. There's the general ordinary income tax rates, which I'll show you the tax brackets on the next slide. But in addition to that, you have certain income items that are not ordinary income, and they have sometimes preferable tax rates, like long-term capital gains has a 15% or a 20%. That 15 versus 20 That's also applies to the qualified dividends. And those rates generally, the 20% rate applies when an individual hits the highest marginal tax bracket in the United States. So if you're in the highest marginal tax bracket, that long-term capital gain or qualified rates jump from 15 up to 20. There's another tax that's assessed through the filing of a U.S. tax return, and it's really not the IRS doesn't classify this as an income tax, so it's not creditable with foreign tax credits, and it's called the net investment income tax. So this is an additional 3.8% that's assessed on net investment income. Okay, that's if you have an overall adjusted gross income of over 200,000 if you're single, or what is it? I think my site, yeah, 250 if you're married. And so anyway, this is an additional. So a lot of people come in and they'll, I have a long-term capital gain. What are my tax rates? Well, it's the 15 or the 20 plus this 3.8%, and you're not going to get a credit on that 3.8%. The other thing that comes up a lot on your federal income tax return is self-employment tax. So if you are self-employed or work for yourself, then there is an additional, they call it a self-employment tax. And basically what it is, it's the U.S. social taxes. So again, not creditable because it's a social tax. It's the U.S. social tax, which is the FICA and the Medicare. You can see the rates down below. It's that piece, the 6.2 and the 1.45%. And the 6.2 is only up to the $160,000. So and then on top of that, you have to, that's your portion. And then the self-employment tax also includes the employer portion of the social tax. So you basically double that up. So it's a total tax if your self-employment income is below $160,200, it's a 15.3% tax. Again, that is not creditable. So state income tax is another tax that comes up a lot. We have 50 states in the United States. Each one has their own tax rules and laws. They vary by state, just to kind of give you an idea. California's maximum tax rate is 13.3% on income over $1 million. Colorado's max tax rate is 4.4%. Florida doesn't have an income tax. So you can kind of see how it can vary from state to state. But something that's really, state taxes are hugely important, especially when you start talking domicile issues. We've already talked about the U.S. social taxes, which are FICA and Medicare taxes, and what those rates are. The FICA is capped at $160,200 of income. The Medicare is unlimited at 1.45. There's an additional Medicare tax of 0.9% if your wages exceed certain threshold amounts. Or self-employment income exceed those self-employment. So there's that additional 0.9% there. All right, I just put this up for illustration standpoint, just to kind of show you what the U.S. tax rates are. And there's actually two of them, two tables here, one for 2022, one for 2023. Just if you're interested, you can look at it. You can kind of see our highest marginal rate is 37%. For single people, that's for income over 578,000 in 2023, and for married individuals, it's for income over 693,750. So anyways, you can kind of see how those rates, and it's a marginalized system, so you're taxed at marginal rates. One of the first things that come up when we're talking about U.S. taxation, we've kind of gone over the basics now. get into a little bit more complicated area, and U.S. residency determination comes up. And so before you go over the two different tests, which are there below, I always ask people, I always start this out. Are you a U.S. citizen? If you're a U.S. citizen, none of this applies. You are taxed on your worldwide income, regardless of where you're at. You have to file a U.S. tax return. U.S. taxes as citizens on worldwide income, unlike most countries in the world. Okay. I think, I don't know, there might be a couple countries that do the tax on citizenship, residency based on citizenship. So, and believe it or not, there's a lot of people that might be living in the UK that may be born to a US citizen and automatically makes them a US citizen. And so we call them accidental citizens. They may live in their whole life outside the US. They don't even know. I actually help a lot of people come back into compliance with the US after they become aware of this situation, this fact pattern. And so that's the first thing I ask. The next question we have is the green card test. And so so generally your residency starts on the first day you're present in the US after you've been issued a green card. Okay. And if you have a green card and in the US, you've received it, you're a resident, a long-term permanent resident of the US. Okay. The next test is if you fail that test and you say, no, I'm not a US green card holder. The next test in determining US residency is, do you meet the substantial presence test? So what this substantial presence test is, it's a 3-year look back rule. You're looking at, first of all, in the current year, if you've been in the US for 31 consecutive days. Okay. If the answer is yes, then you move on and you say, okay, what are my total days in the US in the current year? So let's say that you're trying to determine residency for 2022. You have 160 days in the US in 2022. You go back a year before that, so 2021, and you have, let's say 50 days or 100 days in 2021. And then you have 50 days in 2020. So using this formula here, that adds up to 201 days in the US. You've tripped and you've been in the US for 183 days or more. And so you would be considered a resident of the United States. Okay. Under the substantial presence test. So that's how the US looks at it from a tax perspective, residency. Now there's other things. So you can meet this test and you can still be considered a non-resident of the US by virtue of, in the code section, the closer connection. So if you're in the US less than 183 days during the year, then you can qualify under closer connection if you have a closer connection to the UK. So looking at your personal, like your employment, your social and economic ties, are they closer tied to the UK than the US? Then if you're in the US less than 183 days, you can apply for non-residency using a closer connection by filing an 8840. If you meet the substantial presence test and you're under 183 days. The good thing about the US UK is we have a treaty. So let's say that you're in the US more than 183 days in 2022, but you still feel like you're closer connected to your social, economic, and personal ties are closer connected to the UK than the US. You can still claim non-residency in the US by using the treaty tiebreaker clause of the US-UK tax treaty. The problem with that approach versus a closer connection, and why there's a distinction between the two, is the US rules require you to, if you're claiming non-residency under a treaty position, you still have to file informational returns in the US. And I'll go through what those are in just a minute. That can be very cumbersome and a big burden. So we preferably want to, if you're going to claim non-residency after you met the substantial presence test, we prefer doing it under the closer connection. The other big issue here is when does that U.S. residency really begin or end? And generally, your first day of presence in the U.S. is generally your start date, your residency date in that year coming in the U.S. Now, there's a 10-day de minimis rule that you can apply. It's kind of a tricky rule, but you can slide that after this 10 days or a portion of those 10 days, depending on your facts and circumstances. And generally, your residency ends in the day that you depart the U.S. But you can make an election to be treated for the full resident for the entire year. So U.S. residency determination. So this section, we also have like first year elections to consider. So when someone moves into the U.S. in that first year, how do you file a return? You could be considered a non-resident U.S., a part year resident, or file a dual status return, or you can just make a full year election and file a married filing joint return. It depends on which one of these you can do. If you're married and you're married to a U.S. citizen or a individual that is a resident of the U.S., then that spouse can make the full year election, elect to be treated file a joint return. Okay, that is not always the optimal situation, and the married filing joint rates are generally lower than the non-resident or the part year resident return rates, but it's still not always optimal because depending on your facts and circumstances, you might have certain things that happen. Like if you sell a personal residence in the UK before moving to the US, and if you make a full year election in that calendar year, the UK doesn't tax, and Caroline can correct me if I'm wrong, but I don't, if they tax the primary residence, it's a very small tax, but generally I don't think they tax it. The UK won't tax that, but the US will if the gain on the sale of that primary residence is $250,000 or more for a single person, or $500,000 or more on a married filing joint return. So if you're married and you sell a house that has a more than a $500,000 gain, you may want to not file a joint return so you can exclude that, because the UK is not going to tax it. You won't have a credit, but the US will. And so that causes a problem. So there's some planning you can do with these if you qualify for non-resident versus part year. A part year is you're basically electing just that. You're filing two returns in one. You're filing a resident return with a non-resident return. So it's kind of a split year. So there's lots of different planning that there's reasons why you'd want to do one versus the other. But again, I look at facts and circumstances, what you've done, make that determination, how to file your return that very first year. Why is residency important? And two main reasons. So the top two, US resident, non-resident, you can kind of see here. US resident, you're taxed on worldwide income. That's the biggest issue with being a resident of the US. The next probably biggest issue is, so when you are taxed on worldwide income, there's a potential of double taxation on certain items. The other big issue though is foreign asset disclosure, and I'll get into that in just a minute. But these are like the two main issues. If you're a non-resident, the only thing that you have to file and report taxes on in the US is your US source income. So income earned in the US. So if you're physically present in the US working, earning a wage, even though you're on UK payroll, you're in the US, for work purposes, that's US source income. If you have income from US real property, that's US source income. All that would require if you're non-resident US, to be reported on a non-resident return. US citizen, like I said before, always tax on worldwide income, no matter where they are. They're always subject to foreign asset disclosure. So I just kind of real highlight, these are a list of all of the foreign asset disclosures. The most common one here is the FBAR, the foreign bank account reporting. Some of these top two are informational only. They get filed, but the other forms income can flow through on these forms onto your personal returns. Okay. So they're not all just informational returns. And the reason why these forms are also important, other than reporting income, is what's captured on the next two slides are the penalties. You can see here that failure to file the FBAR forms is a $10,000 penalty for each failure to file. And if they feel like you're willful, that could be $100,000 or 50% of the balance. You can see the different civil, and then the other big issue, the biggest issue is if you're willful in your failure to file, there could be criminal sanctions brought against you. The biggest issues here are these penalties, and why we want to make sure. I spend a lot of my time every day dealing with people who have missed these and helping them come back into compliance with this. The IRS is starting to ramp up their reviewing, their auditing of these forms. They're hiring more people to look at these. More penalties are being issued on these forms. They're scary when an individual gets on a 3520, it could be, I've seen them several hundreds of thousands of dollars that they've gotten because they didn't file a form on time. And so we can try to help you get out of those, but it's kind of a scary situation. So you want to make sure you're fully in compliance with these penalties.
I would like to mention too, Jared, on the penalties, that some of the forms have automatic penalties if you file late. So for instance, the 5471, if you discover that you should have filed it and you file an amended return to include it later, which is the only way that you can come forward and file it late, their computer system automatically will kick out a penalty notice to $10,000.
The same for the 3520s and 3520As. And what I found with them is sometimes they're computer generated. So sometimes like they're not subject to the penalty, but the IRS does. And so then you go back and tell them why they're not subject to it. The agents that look at it are not the ones that understand the rules and laws, and they'll say, oh, that's not reasonable cause. They're still subject to it. So then you have to go all the way through the appeals process to get out of the penalties. It can be a nightmare, like a long drawn out process, really is what it is. So the best defense here is not to be late and to be fully compliant in these reportings. So okay, we've talked a little bit about pre-immigration planning. So advanced knowledge is always best. So if you're moving to the US, let's talk before you move. It gives you the most options. It gives you some planning opportunities. It's not always possible, but if it is, then like even if you're thinking about it and you want to know, that I'd say let's invest in a little bit of time and let's have a conversation. Okay. We've already talked about some of the opportunities to plan and do some planning around real estate and rental properties and the issues there. The other issue that you want to be aware of is bonus and stock options. They create trailing liabilities on both sides of your assignment into the US, coming to the US. So if you have stock options or bonuses that are earned in an earlier year in the UK, and you come to the US and then they vest or they are paid out while you're in the US, well, because they were earned while you're in the UK might have, they want a stake in those assets, okay? Same thing when you leave the US, right? So depending on tax rates, which ones are more optimal, some of the planning opportunities you want, if you have control over when you receive these, try and defer or accelerate vesting periods or earning periods might be a way to save some money, okay? The other things that are really important are foreign assets, and we went over all of that, but common foreign asset issues I see with UK individuals coming to US are for UK pensions. I put foreign pensions, but it's UK pensions primarily, or in this situation. But I've seen UK persons with other countries' pensions too. So non-US pensions. Non-US pensions are not necessarily treated as qualified pensions. The nice thing about the US and UK is they have a optimal tax treaty that says that the UK pension will be treated as a qualified US pension for US tax purposes, meaning the deferral of income that a pension, usually you put money in a pension, you wait till it grows, and then you pull it out when you retire, and you don't have to pay tax on that growth until you start pulling money out. Well, that's the qualified piece that you don't get, but with the UK US treaty allows us to do that. So but there's, we have to file certain disclosures around them, and they're complicated. You got to find out what they could be classified a foreign grantor trust. So we want to make sure that we know what kind of a pension they are and what they're qualified for. ISAs, individual savings accounts in the UK. They may be tax-free in the UK, but they are not tax-free in the US. So ISAs, you put money in, it grows tax-free, you never pay tax on that growth, and you're able to pull that money out. If you're a US person and you have an ISA, you might have, you're going to have some issues with income. So you're going to have issues that they might be considered a foreign grantor trust. The assets that are wrapped up in that ISA might have some really difficult taxes reporting. So, and really detrimental taxes, high taxes, and it's something that you don't want to have. Actually, it's the next item. Unit trusts and mutual funds are called PFICs in the US. So if you have UK unit trusts and mutual funds, you have PFICs, and PFICs could be included in that ISA too. And they are taxed very aggressively in the US, and the reporting is very difficult to comply with. They're not easy to report. The last thing that immigration planning is like, so if you own a foreign entity, non-US entity, corporation, it used to be, there's a new tax, it's called GILTI, Global Intangible Low Taxed Income. So if your foreign corporation is owned 50% or more by more than 50% by US persons. So if you become a resident, you own 52%, well, your foreign corporation becomes a controlled foreign corporation for US tax purposes, which means that the profits of that company would be subject to tax in the US, even though you may not receive a dividend. And so that's a big issue. And so there's some planning we can do around that. So these are, again, advanced knowledge is critical. Let's talk before you do it, because there's a lot of planning we can do around these areas. So Shannon, do you want to take this next slide?
But yeah, we run into a lot of situations where UK entrepreneurs are coming to the US, and it does have both individual tax and corporate tax implications. So we wanted to cover off on those corporate tax implications briefly as well. Of course, if you're in the US and you're working in the US, you likely have some sort of tax obligation. But also, if you come to the US let's say an executive, a CEO of a company or an owner of a company comes into the US, but a business is still established outside of the US, say still in the UK, then the risk here is that you could be creating a permanent establishment or otherwise known as a taxable presence for your UK company. And of course, we want to be careful about that to avoid having double taxation in some instance. And so one of the things that we often get asked is, well, are we creating a taxable presence by having individuals that are working for the company or owning the company in the US? So with respect to this, we do have a treaty with the UK, and so we can look at the treaty and see if there is some relief there. But oftentimes, if it's a high-level executive, it's really hard to argue that you are not carrying on business in a fixed place in the US. So oftentimes we are triggering a taxable presence. Then the question is, well, what does that mean for my company? We would be allocating certain income to the US in order to cover the costs of what is happening in the US. And so maybe not a huge income tax implication, but there's going to be filing obligations. If you're an employee of the company, that means the UK company is going to actually have to get a tax ID number, file for all those social taxes as the employer, et cetera. And that can become very cumbersome. We've actually helped quite a few UK companies over the past few years come into compliance because people have moved back to the US, especially during the pandemic, wanting to stay here. And so they've created these situations where the UK company also has obligations that a normal US company would have. It can also cause some state and local tax issues, sales and use tax issues. We can be creating that nexus that allows for the US states to then start taxing sales into the US. We also, of course, have immigration issues, as Jared mentioned before. We always want to make sure you're using the right visa when you're here so that you're not getting into those troubles as well. And then, of course, if you have pensions and benefits, making sure that you are following the US rules with respect to those as well. That can be a very complicated exercise. And then, of course, employment law. Our laws are much different than in the UK in terms of what the employment laws say. And so just being careful, especially in different states, there's unemployment taxes and other items that you might not be thinking about that need to be addressed as well. So I always say we need to have a discussion not only on the individual income tax side, but also the implications for the company.
Thank you, Shannon. We're going to talk about U.S. transfer taxes. And just like I thought, all that information up above was so much, and there's a lot to it. We're going to, for sake of time on the rest of this, we'll kind of go through this fast. There's a lot of material I have on these slides for your benefit, so you can go back and look at it. And then if you have questions, we're always available to answer. But we're going to talk now about some transfer tax considerations. So this area falls into the U.S. gift and estate tax rules and laws. In the UK, better known as their inheritance tax. A lot of people talk about the common language differences with the US and UK and how we use different words to mean the same thing, and kind of like the same thing. So inheritance tax is used in the UK. We use estate or gift and gift taxes to mean referring to these transfer taxes of wealth after you pass. So when thinking of a UK individual coming to the US, this is obviously a high level, an area that we want to talk about and plan for, because you never know what's going to happen, especially if you're a wealthy individual that these issues can arise from. So one thing I want to point out with the whole language thing, even though they kind of mean the same thing, the rules and laws in both countries are completely different. And so we got to be careful that, you understand, what they mean. But the US does have a transfer tax, so does the UK. So some of the basics on US estate tax. So the top rate, of course, in the estate tax rate in the US is 40%. So on wealth over the $12.92 million. So that the 2023 exclusion is quite high. And just to kind of talk about this a little bit about the politics of estate tax in the US is, you can see here on this slide that this above exclusion is going to set to revert back to $5 million in the end of 2025. Okay, and that $5 million will adjust with inflation, etc. Why does it adjust? And it comes back to politics. Which office is, which party is sitting in, has control of the Senate or the House, or is in the White House. And typically, the 12.92 million was set back in, I think, in 2017 with the Tax Reform Act. It jumped up with the Republican president. There's speculation now with Biden in the office that, or what's going to happen with this? Will they extend this estate tax exclusion, with another president, at the end of 2025, or will it drop back down to the $5 million? We don't know what's going to happen. And so there's a lot of subjectivity there. So you gotta have to plan for maybe the worst. I don't know. It's really hard to know what to plan for, other than you just got to know what the rules are and then do what's best for you. The non-resident alien estate tax exclusion is $60,000. So what that is not. So the $12.9 million is for U.S. domiciliary individuals. So U.S. citizens or someone that's domiciled in the United States, they have this high exclusion. If you are not a U.S. domiciliary and you have U.S. situs assets, like let's say that you have purchased a home in Fort Lauderdale on the water, and that's worth $1 million, right? And you pass away with that assets as a domiciliary of the UK. Well, you would be subject to an estate tax on that $1 million when it transfers outside on that $1 million less that $60,000 exclusion. So you've got a big issue there, for non-resident aliens owning U.S. property when they transfer their wealth. So U.S. citizens, big question. Like I mentioned earlier, you're subject to income taxes and you're subject to gift taxes. Okay, easy. If you're not a U.S. citizen, then you're generally taxed for income tax purposes. Again, back to green card, substantial presence test, and you have a treaty tiebreaker or closer connection to kind of play with to do some planning there if you need to, right? The nice thing about looking at the estate and gift tax rules and laws for U.S. domiciliaries is that determining U.S. domiciliary is not a black and white test. It's very subjective. So it allows for a lot of flexibility and some planning depending on what your facts and circumstances are. So just kind of keep that in mind, that there's some planning there's more availability to plan for U.S. estate and how to transfer your wealth. Now let's talk a little bit about the U.S. gift tax. So a U.S. domiciliary can gift $17,000 per year per donee. So if you have $5,000 and you're married, if you have 5 children and you're married, you want to give them money and not have it subject to the gift tax. you can give up to $17,000 per each of those children and not have it be taxable. Okay. If you're married, your spouse can also donate or give that $17,000 to each child as well. Non-U.S. domiciliary can also do this. This $17,000 applies. There's some issues with tangible assets, which I'll get into, but I want to kind of clarify this a little bit too. The non-U.S. domiciliary. So this applies to individual. So if you're a non-U.S. domiciliary and you're gifting non-U.S. situs assets, then you can gift whatever you want and not have it be subject to the gift tax. The issue is when you gift U.S. situs assets. And so what are U.S. situs assets? It is cash located in the U.S., U.S. real estate located in the U.S., or personal property located in the U.S. And that's when the gift tax applies, when you're gifting more than the $17,000 to that's U.S. situs assets. Okay. A common mistake made is regarding tangible versus intangible property. So again, on this slide, you're gifting real property over the $17,000. There's some, if you do some planning on that, you can, if you transfer that real property into like a U.S. LLC, and then you transfer the intangible, you transfer your interest in that LLC to somebody else as an intangible gift, then there would be no gift tax issues with a transfer that intangible property versus tangible property. So there's some planning there that you can do. QDOTs. The main issue I just want to point out is, and this is a common tool used to maximize marital deductions with estate and trust planning. And it's common practice in the US. So if somebody wants to do this for you, just beware that it might create a very unfavorable UK tax issue. So before you ever, someone puts your assets, want to transfer them to a QDOT or a qualified domestic trust, talk to somebody first. Okay, that's the point I want to make right there. This is next slide. Oh, double clicked again. Okay, this is just like a little quick guide. It kind of tells you the rules and laws on estate and gift taxing, and when the exclusion amount, the 12.9 or the $17,000 is applicable, when it's not. So this is mainly for illustration purpose for your reference. There's some planning we can do around the concept of domicile that we want to kind of hit on, or that we can do. And then we've already kind of talked about the marital deduction and the QDOT. So there's some planning here. We also want to, we already kind of talked about the planning around the $60,000 exclusion versus the 12.92 for U.S. domiciliaries, right? And the 60 for non-U.S. domiciliaries. So there's a lot of planning, and we can also do some planning around the treaty between the U.S. There's a U.S.-UK estate tax treaty that we can use to do some planning. And usually, when those issues come up between U.S. and U.K., that's a lot of that is ironed out through the treaty, and so we should always factor that in as well. There's a lot of tricky issues with, I think in the UK, it's very common for wealth to transfer through probate. And I from what I understand, it's fairly straightforward. In the US, not so much. So there's some things that you would want to do in the US to try to precludes your assets from going into U.S. probate. If you put these into revocable trust, a lot of times because those assets transfer to trustees, there you can avoid some of the probate issues that come up in the U.S., which is kind of a sticky issue in the U.S. And trying to get assets out of probate and transfer the right people can cause some problems. So the last section is U.S. trust tax considerations. Is a trust in the U.S., setting up a trust in the U.S. a good thing? Okay. I'll just say many people right now say that it is, and it proves because lots of money from outside the U.S. is coming in and being set up in trusts. And because of our favorable trust rules and laws, and primarily in these 3 states, South Dakota, Nevada, and Delaware, these 3 trust jurisdictions have very modern trust law that appeals to individuals outside the U.S. So if this is something you want to look into, it is something. I would always say on the trust side, be careful what that does in the UK. If you were to move back and you have a U.S. trust, and you want to look at both sides before you set one up, but you can kind of see all the benefits of having a U.S. trust here. And anyway, these 3 states are the 3 kind of the hotbeds of trust jurisdiction that are out there. These are the types of trusts in the U.S. Grantor trust. This is mostly for it's treated as a flow through for U.S. purposes. So the income in the trust flows through to the owner's individual or personal returns. And then you have non-grantor trust. Those incomes are distributed annually, and then you have to the beneficiaries. And then whatever is not a grantor, non-grantor is the complex trust. So we those are kind of the 3 overriding trusts in the U.S. So a lot of this is the rest of these slides, and I'm just going to kind of probably stop here, around foreign trusts. And so it's very common for UK persons to move into the U.S. with a trust. They're either a beneficiary or they're an owner of a trust. There's significant reporting requirements on forms 35 and 3528. Those forms are on that informational reporting with the large civil penalties. So you want to get these right. And we want to make sure we understand. So we'd want to analyze your trust documents before you come in and determine. The rest of these slides just kind of go through and set this outlines from a trustee standpoint for a foreign trust with a U.S. owner. So if you move in, you own a trust, you move in, you're the owner of this foreign trust, you have a reporting requirement of 3520 and 3528. These slides kind of go through what that reporting requirement is, and as for the trustee, as well as for what should be done for the beneficiaries. And
Jared, I think maybe the key point, because there's a lot of information in the slides that they can go through.
Yeah.
But for UK entrepreneurs, I think the key point is that there is some planning that we can do around trust before coming to the US. So getting that advice in advance is really, really important, because we can get ourselves into sticky situations that we can't really get out of once you're here. So I think with that, we'll wrap up, since we're just about at time. And I did want to ask Caroline if she has any comments or thoughts on the presentation and from a UK perspective.
I think, Shannon, you've just summed it up perfectly. I think for me, the key point, there's so much useful information in that, Jared. I can't thank you enough. But the key point must be to speak and to discuss and to plan in advance before you move to the US. And then once you're in the US, don't forget to continue to discuss potential implications with your advisors back in the UK. But that's where collaborations between firms such as ours is so helpful, because we can we can join the dots between you and make sure you're protected in both jurisdictions.
Thank you so much. Jared, thank you so much for the wonderful presentation. A lot of really good information. And Caroline, thank you for joining us, and have a good evening. And for the rest of us in the US, have a good day. And we hope to see you in our next month's presentation, where we're going to talk about US persons going to the UK. So it'll be sort of the opposite of this presentation, going the other direction across the pond. So thank you so much.